think capital efficiency has always been the foundation of what we do. Too many startups spend recklessly and struggle when funding dries up. And we back founders who can do more with less. We love founders that are scrappy, they're capital efficient, they're methodical in their growth, instead of the grow at all costs mentality that you see more in venture. And lean doesn't really mean small. Like some people think, oh, you're like into, bootstrapping. Not at all. I think it's just the order of operations. We are big advocates of when you start in the very early stage, being very responsible with the money and the capital. And we're fine if, once you hit a point, you want to grow and raise growth equity or, etc. I think for us it's more a question of optionality and having agency of what to do with your company. Some people don't realize that they start like racing, and then they get to a place that they don't even have control. So for us, it's all about optionality and owning your own destiny.
Hi, everyone, and welcome. We are joined today by Maria Gonzalez-Blanch, investor at Crescent Ridge VC. Maria, thank you so much for joining us.
Thank you so much. I really appreciate your time, and I'm very excited to be here today.
Absolutely. So off with something a little bit easy. Can you just tell us a little bit about yourself? What did your professional journey look like? How did it lead to you entering the venture capital space?
Yeah, totally. So just a quick overview. I'm the managing partner at Crescent Ridge VC. We're an early stage investor focused on capital efficient startups in health, people, and planet. We're very passionate about building great businesses, not just funding them. And very quickly, a story about me. I'm originally from Spain. I studied engineering. I moved to the US in 2012 to go to business school at Stanford. And my background is very diverse. I've been in consulting, engineering, manufacturing, startups, private equity, and different operating roles. And all of those shape my perspective on investing and entrepreneurship. And I realized I love helping companies grow strategically. And that's where it led me to go to venture capital. I've been in San Diego for over 5.5 years. And that's when I met Allison, who's the founder of Crescent Ridge. And I joined the firm to keep focusing on funding capital efficient businesses that don't need to burn excessive capital to scale, and working with founders that are very mission driven and that are doing something good for the world.
Thank you. I really appreciate it. I think we're going to touch upon a couple of those topics, but I wanted to start off with the three pillars you just listed: health, people, and planet. Are these three pillars an important focus for you and your firm?
Yeah, sure. So health is part of our DNA. We're like really into longevity, wellness, preventative care. Without your health, you have nothing. You cannot do anything for the world. So that's really like one of our most important pillars. And there's a huge opportunity, it's massively underserved, very important for us. In terms of people, again, people are, the most important thing for business to work well. Founders, employees, communities that make or break a business, and companies that prioritize people outperform. So we always are looking to work with companies that really focus on people, like underserved communities, etc. And in terms of the planet, sustainability is not just like a feel-good factor or ESG or whatever. We're like thinking about it as a long-term moat, and taking care of our planet is ingrained in our DNA. Same way as we look at, the health components, like taking, everything has to be good for the planet. Otherwise, what's the point?
Yeah. No, that's really interesting. And I think, just along those lines, when you think about those three pillars, are you looking specifically at companies that are actively in those, really around those themes? Or like, how does that integrate into some of the companies that you meet and that you ultimately invest in?
Yeah, I mean, at the end of the day, we're looking for founders that are know the very, very well. Um, and also, that are, sorry, I'm cutting off. Hey, hello?
Yeah.
Oh, okay. Sorry about that.
Yeah. Yeah.
So yeah, we're looking at those three, yes, like most of our investments, if you look at them, they are like helping specific demographics. But we are open. Can you hear me again? I think the connection is a little bit unstable. Can you hear me?
Yeah. Yeah. I can hear you. Can you hear me?
Yes, yes. Okay,
Oh,
sorry
okay,
about
good.
that.
Good, good, good.
Yeah, so
Okay.
Health People Planet, they have to be good for all those three. But it's just working with good people that understand their industries really well, they understand the problem really well, and they're solving like for a problem that is, going to be good for the world.
Yeah. So you recently wrote an interesting article titled "The Lean Elephant in the Room," and I found that article incredibly fascinating. Can you share more about how this became Crescent Ridge's North Star and really how it influences how you invest?
Yeah, I mean, I think capital efficiency has always been the foundation of what we do. Too many startups spend recklessly and struggle when funding dries up. And we back founders who can do more with less. We love founders that are scrappy, they're capital efficient, they're methodical in their growth, instead of the grow at all costs mentality that you see more in venture. And lean doesn't really mean small. Like some people think, oh, you're like into, bootstrapping. Not at all. I think it's just the order of operations. We are big advocates of when you start in the very early stage, being very responsible with the money and the capital. And we're fine if, once you hit a point, you want to grow and raise growth equity or, etc. I think for us it's more a question of optionality and having agency or what to do with your company.
Mm.
Some people don't realize that they start like racing and racing and racing, and then they get to a place that they don't even have control. So for us, it's all about optionality and owning your own destiny.
Interesting. So, do you think that founders can learn to become more of this lean elephant or this more of a capital efficient? Or do you think it's just part of a founder's DNA in terms of how they think about growing their startup and their company?
I mean, I think some you can learn, but I do think it's the founder DNA. I think you have to play the cards and play the game that you can win. Some founders are great at fundraising, awesome. So then go and fundraise and do that route. But I think like we keep saying, in the venture world, like it's a one size fits all, and everyone has to fundraise, and you have to do this, and you have to pitch, and I don't think that's everyone's strengths, and some people are really really good at doing a lot with less. And by the way, I think that's a really hard skill. And I don't think like the people that cannot fundraise and are not great at fundraising are automatically like good at doing a lot with less. It's almost like a little, people think about unicorns, billion-dollar companies. I think it's so hard to find those founders that are really, really good at doing more with less. And I think some you can learn, but a lot of it is really comes in the DNA.
Got it. So again, along those lines, I mean, again, when we're talking about the DNA, we're talking about how companies can create new optionality. In the age of AI, and we have to talk a little bit about AI, and we're starting to see some of these funding numbers and some of these growth numbers that we're seeing. How does that how does that influence you and the work that you and your partner are doing at Crescent Ridge VC in terms of how you invest? And is that going to change the type of industries that you influence or that you invest in? I'm just kind of curious to get your thoughts about AI startups and fundraising.
Yeah. So yeah, in terms of AI, of course, it's changing everything already, and it's a huge change. It's changing by the minute, by the day. For me, AI is a tool. I think long term, it would be a thing in itself. It's just like the internet, right? So I think it will be more commoditized. I think AI, I'm an optimist. I think AI is great and, leveling the playing field for a lot of entrepreneurs, can do a lot with less. They can do prototypes, they can do everything, right? In the past, you would need engineers. Now it's like very cheap. So I love the ability of AI to augment human work, especially very excited about all the applications in healthcare, diagnostics, etc. So yeah, I overall believe that AI is great. We don't see it as, like as an end in itself and looking for AI startups. Like I think a lot of funds are, going and buying the lottery tickets on AI companies. That's not where we personally feel comfortable. I think AI as a moat in itself, everything is going to have AI. And we've been, I think there's a lot of challenges as an investor because there's a lot of hype versus the real utility. There's a lot of data privacy and security. So there's a lot of things that are coming with it that are coming so fast and that are tricky to navigate. But overall, I'm very optimistic. I think like we see it in our portfolio companies, they're using it, they're being more efficient, they're doing more with less. They don't have to hire as many people. So I like it. I mean, I'm very optimistic about it.
Okay, great. And so along that, what are founders doing differently that have impressed you lately? Is there something that you're seeing that founders are doing that are just really kind of innovative in terms of the way that they're growing their startups, the way that they're thinking about their customers and their market? Just kind of curious to see what you're seeing.
Yeah, I mean, there's some founders that are doing things differently. There's other founders that are not, the venture industry in itself is in some ways not changing very much with what is going on. So that's why it's kind of a mismatch and it's hard. Um, but yeah, I mean, I think some founders are just doing more with less. Some of them are bootstrapping more often. Um, at the same time, I see, things are changing a lot, and I see founders trying to fundraise um, with, terms that don't make sense, and in the same way that would be like 2 years ago or 3 years ago. So I think there's good and bad. I mean, there's some founders that are doing impressive things, just one person, two people, like running like, you know, already having like a lot of revenue. That's very impressive. I absolutely love that. I think on the capital side, things are moving a little bit slowly.
Mhm. In terms of your portfolio, is there a company or an example that you can think of from your portfolio that has been exemplifying some of this impressive way that they're growing?
Yeah, we have some consumer companies in the consumer space that are, again, running like big businesses with very few people. And a few years ago, I wouldn't have expected that that was possible. So many of our portfolio that are in the consumer side of things are doing that.
Got it.
Yeah.
So if we look on the other side, we're looking at some of the impressive things that some of the companies that are in your portfolio and that you're coming across. What are three most common pitfalls or red flags that you're seeing in companies that are really not fit for investment, or at least not a good fit for you and your firm?
Yeah, I think like people that are really focused on the solution and technology, I really like when founders understand the problem really well. They've been in the industry forever. They get it. I think the moat more based in technology and, AI and all that, I'm not so excited about. I'm more excited about you've been in the industry forever. You have these relationships, you have this distribution, the trust of these people, these customers. That's when I'm more excited. So when they're very focused on, the technology and the solution, I'm more worried. I think the people that are burning cash without traction and spending a lot of money before they even know if people want their products, that's a huge red flag. A lack of clear go-to-market strategy and just the plan of, oh, I'll just, spend money in social media or in marketing. That's a huge red flag to me. And overinflated valuations, or people don't have anything and they want to raise on a $10 million safe or whatever, right? I mean, that's, I hate safes, by the way. So yeah, I think some of those are classic red flags for me, but there's so many more.
So, is there any advice you'd give to a founder as they're thinking about actually fundraising, and just kind of taking into account some of these red flags, things that they could do to try to avoid some of these mistakes?
Yeah, I mean, I think as a founder is just understanding what are your strengths. I mean, if you're like, the best at pitching and getting like all the big PCs or whatever, that's fine. But like, is that really what you want? I think it's understanding what do I really want? What are my goals? And then finding capital that is aligned with your goals and really getting to understand them. Or maybe you don't even need capital. I think like people just go straight into the capital, and it's like, maybe you don't need it. And then understanding what you need. Capital is not just money, there's many other things, right? So some of them have experience, they can offer strategic guidance, network access, some support in different ways. So I think just understanding your strengths and your limitations and finding, what is the right capital for you.
Got it. So, the macro environment has shifted considerably in the last 3 to 4 months versus where we were just a year ago. How has the macro conditions changed or influenced the way investors and founders are engaging with one another? What are some of the things that you're seeing just in the conversation that you're having? So I'm kind of curious to get your take.
Yeah, I think there's a shift from growth at all costs to profitability, or at least that's what investors are saying. I see that shift. I think like investors are getting a lot more picky. I think there's more creative deal structures. I think in the past it was just saves or price rounds or whatever. I see a lot more, different options, revenue-based financing or price rounds with different terms. I think like some of the terms are changing a little bit. I think there are less FOMO investing. Investors are doing deeper diligence. I think that's a good thing. Founders they're forced to be better. But at the same time, I see a lot of founders not raising any money. I see a lot of founders that, I did that, been there, done that. I don't want to do that anymore. And I think that's great too. I don't think like venture is a cure for everything.
Very true. Very true. So I think one of the things that makes Crescent Ridge VC unique is the way that you and your firm partners with portfolio founders. And so we've talked a lot about funding or fundraising. So beyond providing funding, just that role that investors can play as a mentor, as a partner with the founders themselves. So what do you believe is the key to a successful match between an investor and a founder and to have that kind of relationship?
Yeah, I think like everything starts with self-awareness of the founder, what are really good at, what do they need, and investors, like what are you good at and what can you offer, what can you put on the table, right? So I think that exercise is very important. I think alignment on vision and values is super important. The best investor-founder relationships really feel like true partnerships. And it's not just about the money, but it's like, do you want a capital partner? It's not, I want the money, right? So I think it starts with that common, finding the common ground on vision, values, philosophy, and also like, really understanding what everyone is bringing to the table. I think for us, we've learned over the years what we're really good at, what we're not so good at, and we try to be very upfront with founders with what we bring to the table, and sometimes it's not a match, and that's fine.
So I think on those lines, I think I'm kind of curious when investors, as you say, bring more than just capital. They're a capital, they're a partner. So what are some of those other kind of opportunities or resources that that you see investors bringing to the table when it comes to supporting startups in their portfolio in particular?
Yeah, I mean, as an investor, you have to open up your network. And some investors are really good at finding the capital to the next round, right? And personally, that's not our best, our skill is more like how can you do more with less? And yeah, of course, if you're gonna fundraise more, that's fine, and we're supportive, but we're gonna get you to a place of stability and financial freedom. That's one of our skills. We are all about, not just creating financial wealth, but what are you doing with your companies? You just want to make money and that's it. We have like an internal framework that we use to make decisions. People really love. It's called four-dimensional wealth. And we're looking not just at the financial dimension, which is one of the, dimensions, but is relational wealth, which is creating very deep relationships between humans. Social wealth, creating a good impact in the world, and intellectual wealth, doing something creative and bringing something new to the world. So a lot of founders really like partnering with us because we bring a refreshing perspective on business building. Like I think most VCs are very cookie cutter. They have a playbook and that's what they're thinking about. I think for us, it's a canvas, right? I mean, we're both very creative and we're very open-minded on how to build a business. And I think business in some ways is more an art than a science. And I think a lot of the traditional venture is more like, a science. It's like, oh, you have to put money here. You have to do this playbook of this company. I think what we're really good at is reimagining that. And, it's just really holding founders accountable on their mission and really find the alignment of this is what you want to do and I'm going to hold you accountable because your mission is to make a healthier world or whatever, right? And just bringing back that alignment. And I think we've been in the industry for a long time, and just bringing that sophistication.
It's interesting, and I think that sort of relates to the three pillars of your firm. But just kind of along those lines, some founders start their companies from a desire to make an impact or spark change in the world. So, do you feel that VCs have the ability to make social impact, and do you think VCs have a responsibility to make that kind of impact?
Um, I mean, I'm not gonna judge any moral, the moral of the people, right? I think for us it's very important, and we try our best. We have like investment committee. They hold us accountable with a lot of these decisions. Even when we invest in a company, we have to hit all the dimensions, right? For us is yeah, we have that mandate, and that's what we really want to do. I don't think that's the case for a lot of funds, and that's fine. I think a lot of funds, their mandate is to return the more money to the LPs, the better. And that's fine. But, I think as a founder, you have to understand how the business model works. I think we don't have LPs. We have just one institutional investor and a few other partners, such as myself. And we have a lot of freedom in how we want to make the decisions. And as when we take a lead on a deal, we're on the board, and that's really we have a lot of influence on those decisions. And I think for us it's not just about having a markup in the next round and raising more money. Is what is the best for the company and how can we align the mission of the founder, what they want to do with their actions.
Got it. So curious on this, something else that makes kind of Crescent Ridge VC unique is that it's a female-led venture capital firm. And I know it's unfortunate that we have to say that in that way. But today there's still a major disparity between the funds allocated to female-founded startups versus male-started founded startups. What do you believe needs to change in order to equalize the playing field?
Yeah, honestly, I don't love this question because it assumes women are at disadvantage. Who said that's true? But yeah, this is a very complex issue. I think it's deeply rooted in history, networks, biases, and it's not something that is going to change overnight that we can fix. And people tell you, oh, we need more women writing checks or whatever. That's a very simplistic way of seeing it.
Mm,
It's very nuanced. But I believe in playing the game you can win. If traditional VC isn't it, why waste your energy forcing it?
mm,
So what if you can raise $100 million? The VC model itself is broken in so many ways. So chasing huge rounds isn't always the best path. There are plenty of early stage investors, angels who back women, and you just have to find the right capital for your business. And I think women are really amazing at being capital efficient, doing more with less. They're, I mean, over 70% of our founders are women. They're great entrepreneurs. They're really good. That's a competitive advantage. It's not a weakness. So I think we can thrive with or without mainstream VC.
mm.
It's about building a great business, not fitting into a broken system that is like an industry. So yeah, that's my 2 cents in a nutshell.
Actually, on that note, I think also the when you have female founded companies, they're statistically more profitable and they last and they're able to stay in business far longer than some of their other counterparts as well. So that's a fair stat. So just in closing, any kind of final thoughts, any advice that you would give for founders who are looking to potentially work with your firm and or firms like yours, the type of unique philosophy that that you have.
Yeah, I mean, I think it's all about doing that self-awareness work. What am I building? What I'm very good at? Is this even something I should be building? And then what are your goals? What are your objectives? And then try to understand who are the right investors for you. I think, you know, there's so many different type of investors with different mandates. So just doing that exercise is very important. And yeah, trust your intuition as a founder. Don't hear all the advice out there that is very generic.
Well, thank you for that, and thank you for all your insights and kind of sharing your unique journey and your unique perspective. Thank you again for joining us today.
Yeah, thank you so much for having me. Such a joy.